From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, April 24th, 2026. Let's have a look at the calendar. The Brewers start a 3-game set against the Pirates tonight at AmFam Field. Still hurt saying it that way. And speaking of games, fans of board games, video games, and everything in between will be gathering downtown at the Baird Center for the annual Midwest Gaming Classic. Now, if you prefer the silver screen to a controller, the Milwaukee Film Festival is still going strong through the end of the month. We're told prom is about the magic. The dress, the lights, the slow dance, and the sleek tinted windows of a stretch limo. But for a group of kids in Kansas, there were no champagne flutes or leather seats. Their magic was 27 feet of orange and yellow glory. The Oscar Mayer Wienermobile. They didn't just make memories, they ensured for the rest of their lives. Every other accomplishment, graduations, weddings, promotions, will be preceded by the same sentence. Yeah, but remember when we took the giant hot dog to prom? Next up, move over, Gen Z. We have 2 new record-breaking 15-year-olds in town. First, let's go to Maine, where Gertie the Chicken was just named the oldest living hen on record. She's basically the golden girl of the coop. Then, across the ocean in Surrey, in the UK, we have Herbie, a rabbit, who has officially become the oldest living bunny on Earth. At 15, Herbie isn't just hopping around, he's yelling at the younger rabbits to stay off of his lawn. I just hope when they hit 16, someone treats them to a nice ride in a giant hot dog. Finally, funny headline of the week. England Nature Festival organizers clarify it is not a nudist event. Apparently, getting back to nature was taken a bit too literally by some. Around the table today, we've got Joel Driesing, Art Rothschild, Adam Bailey, and looking back at the week, here's Kyle Tedding.
Well, thanks, Jason. A very special podcast today, and I think we'll save the best for last. But first, the numbers. NASDAQ up 1.5% this week, closing at 24,837. The S&P up 0.5% this week. That's 39 points, closing at 7165 on Friday. And the Dow Jones Industrial Average lost 218 points on the week, down 0.4%. Most of it, or about a third of it, coming on Friday. For the year, NASDAQ up 7, the S&P up 5, and the Dow Jones Industrial Average up 2.8%. Adam, perhaps the place to start this week amidst the heart of earnings season, still coming fast and furious, and we are certainly getting earnings reports that have been quite encouraging, I think, for where the market is right now. I think we could have started a million different places with the war, with what's going on at the Fed, but I think rightfully so, earnings have been the thing that has given us a lot of hope that at least what's going on here continues to be pretty strong and steady.
Yeah, what do we say? It's all about interest rates and earnings. And we're in the middle and the meat of earnings season right now. Earnings season has come in pretty good. A lot of the earnings have been ratcheted up higher from earlier expectations, which is actually a bit unusual. Usually you see the earnings ratcheted back, but you see some of the pressure taken off from tariffs. You see some of the pressure taken off from maybe some peace in the Iran war. And earnings are looking pretty decent, especially coming from the technology sector. They are driving a lot of the earnings growth. You've had some decent earnings in the banking sector. It has been a little bit of a mixed bag there for some of the banks that have had exposure to private credit. But I'm thrilled to see that earnings expectations for full year could be as high as somewhere as 16 to 18% in terms of earnings growth. Now, a lot of that, though, is expected to come in the second half of the year. So we're going to have to see that materialize if we're going to hold on to levels. But it's good to see that earnings growth has been pretty solid so far.
A pretty strong rally in the last month. We look at the markets coming back, especially the S&P near record highs. And for a while, it had been some other areas of the market than what we were used to that was leading the way. You gave me a new acronym in your notes to the show, the HALO trade. What are you seeing recently, and what kinds of things are you talking to clients about?
Yeah, it's been a spectacular year for not being distracted by things that are otherwise distracting. Last year, we had tariffs being the big distraction. What was their impact going to be on spending, inflation, earnings? This time around, it's the war in Iran. And week to week, day to day, as the headlines change, so does the market's reaction, to that change. I'm pretty excited that the stock market has moved higher. And back to that halo question you asked, when I was on the show a month ago, we were talking about this. McDonald's and Caterpillar is, two good examples of things that people are going to be buying, regardless. And people were shunning the tech stocks. Today in the news, everything was, we got to buy Intel, which is setting records, with the government owning a big chunk of it. Let's cash out of that as soon as possible, and buy Spirit, of course. But so to me, having been in the game for a long time, having advised clients for a long time, I think what we do here that makes the most sense is diversification. And so we started the year with value stocks doing exceptionally well. We started the year following the best year in over a decade for foreign stocks. Those continue to do well. Now this tech stuff is coming back. It's lovely, but it's volatile. So I don't want to book a portfolio with too much, in the tech trade. And with the NASDAQ, again, up 7%, I believe we had a correction in the NASDAQ. I believe we had a correction in the Dow. The Dow will always lag because it's boring, conservative, halo-type stocks, among others. And the S&P driving right down the middle of the fairway, up 5% year to date. I'll take that year after year after year. And by the way, this is the fourth year in a row we're going to be making some serious money if it ends that way, and I'll bet on that. Not illegally, hopefully.
Well, the poly market and Kalshi trades are certainly in the news. I'm not sure that's an area we're going to give too much advice or too many recommendations. But I do think it's interesting. We look at the earnings piece that we were just talking about. We look at some of the recent recovery. And one of the things that has kind of been hung over our heads is the path forward for the Federal Reserve. We heard very, very recently as we record this that it appears the investigation into Jay Powell has been dropped. It all but paves the way for Kevin Warsh to take over leadership at the Federal Reserve. And there are some pretty meaningful potential changes coming. The one that was interesting to me is Warsh's opinion that the Fed's insistence on forward guidance may no longer be a path that the Fed chooses looking ahead. It was interesting in that is some forward guidance he's giving and saying he's not going to give forward guidance. But more importantly, I think it does speak to the fact that we are in a period of transition now with the Federal Reserve. There is a lot we should expect that looks different. And so I think as we kind of think through the interest rate environment looking ahead, a lot of it obviously tied to expectations for inflation, but certainly there is quite a bit going on with the Fed.
And Kai, I'm sorry, Mr. Warsh is also talking about the Fed being less interventionist, which I thought was interesting because it's been more interventionist in recent years because they're the only ones doing anything about the economy. Congress hasn't been doing anything. And so we've needed the Fed to be more active, to use the monetary policy to do some things that we could be doing with fiscal policy that we weren't.
One of the things that I found interesting is the chance that the Federal Reserve might get rid of its symmetric inflation target. Where Kyle and I, you had a chance to listen to what was one of the Federal Reserve voting members at the time many years ago speak in Marquette about this. I think he's long since retired from the Fed. But the idea is that if you spend all these years below average inflation, you have to spend several years at above average inflation just to be back to average. So they're considering removing that symmetric inflation target, and that'll be interesting going forward.
I think talk is cheap. What he said at the hearings didn't impress me, quite frankly. The talk about change and to actually change something are two different things. I think they're going to be very deliberate in any changes. That having been said, consistent with what you just suggested, now that prices are getting higher, due in part to this war in Iran, I don't think it's inconceivable to see the Fed raising its interest rate, or the inflation targets. And so the question is, what does that mean for investors? For stock investors, I think it's good news because I think it means corporate profits are going to be higher. For bond investors, it's a conundrum because it could mean that we're going to have higher long-term rates, which actually is good if you aren't too far out on the yield curve. So it's going to be very interesting to see what they do. But as you suggested, Joel, it was the Fed that came to the rescue, when Congress wasn't doing anything. Now Congress and the president are doing things. And so maybe Fed policy has to change in reaction to that. That's what I'm going to anticipate.
And Congress could be changing, so that whole interventionist Congress, if you will, might not be playing out as much either. It's also a good time to remember that the chair gets the same vote as the other 12 people on the Federal Open Market Committee.
Yeah, it's a reminder that it is a committee that sets the interest rates, and there's 12 people. Mr. Warsh, if he is nominated and accepted, he would be one of the 12 voting members. And if he wants to do anything different, he's going to have to convince the other 11 with a very compelling economic case on direction of interest rates. But it is the committee that makes the decisions.
What has been interesting to me about that conversation is part of what we thought the administration was looking for in nominating a new Fed chair was someone who was going to be willing to cut rates. And Warsh may be coming in at a time in which that's a tougher thing to do. Art, you mentioned maybe the expectation for actually some higher rates. As a bond investor, I welcome higher interest rates. It means I get paid to own those bonds. That was a really big problem going back to 2022 when we came from 0 and went to 5.25. It's less of a problem coming from 4 or 4.5 and going to 5.25 or 5.5 because, oh, by the way, it's a smaller jump and you got paid to own the bonds you already owned. And so I think, excited about the prospects of rates at least stabilizing, even if they don't come quite back to the levels they were at, because I think long-term lower rates are a bad thing for bond investors. They create perverse incentives. They create incentives to take risks sometimes in the wrong ways, in the wrong areas. And I think an interest rate environment where we presently are signals some health for the economy overall, that those rate cuts aren't necessary. The challenge, of course, is that we may be dealing with an inflationary environment that takes away some of the Fed's ability to do what they want to do and instead requires them to do some things just to stay ahead of the problem, with full knowledge that the Fed's tools are probably the worst possible tools for these current inflationary pressures. Joel, we had a bit of economic data this week, retail sales, one of the better readings we've seen in a bit, and a lot of nuance, a lot of noise, but encouraging given how much we care about what's being spent in our economy.
Right, and we can start by today's figures from the University of Michigan about consumer sentiment, where people's confidence in the economy and in their own personal finances is the lowest that we've seen in almost 4 years, when when inflation was near a 4-decade high. So it was pretty bad then, pretty bleak, sentiment was low, which suggests to economists that consumers aren't going to be spending money. But we have the report from March on retail sales, and that represents 2/3 of what consumers spend in this country, and consumer spending represents 70% of our gross domestic product, and as you said, that was pretty good. So we're still seeing this disconnect between how people are saying they feel about things with all that's going on. A year ago it was the tariffs, as Art said, and now it's about the war, but there's that disconnect between their low opinions and their resilience at continuing to spend money.
Yeah, and maybe the connection to those, at least in this week's numbers, between consumer sentiment and retail sales, yeah, consumers are pretty glum and pretty sour right now, in part because stuff is expensive, especially gasoline. And what was the single biggest reason for retail sales coming in as positive they were? It was a 15% surge in gasoline sales. So we would pay more at the pump.
Yeah, but this thing is so outdated. Let's be real. They survey everybody to give everybody a vote. American Express just came out with their earnings report showing the rich people are spending money. These tax cuts have been skewed toward the wealthy. They're spending more, no matter what. So quite frankly, they should weight these things, okay? Because not only are wealthy consumers, spending money, but businesses are spending more than ever. So capital, spending is higher for years. That was the problem. Companies weren't spending. Throw that out the window. So higher oil prices, higher plane ticket prices, the rich are going to absorb that. It's nothing to them. I feel bad for the poor that don't have it. They should buy more stocks, make some more money, and get wealthier, for God's sake.
To the extent they can, right? But
Exactly.
I think, Art, you put in some of your notes to today's show exactly what we're talking about in your comment about how important cash is, right? And I think we have talked to our clients, not to pat ourselves on the back because we're not the only ones, but we have talked to our clients for the better part of the last 3 years, candidly, in what has been basically a market that went straight up, that they needed safer things in their portfolio, that they needed liquidity because they have money, because they've saved. They don't now need to take too much risk. And what we essentially were thinking is there is going to be a month, a quarter, a year at some point in time in which something bad happens. And we want our clients to be comfortable in the knowledge that they can spend the money they've worked for, that they've saved for, and that we have set aside some of that for today, tomorrow, 6 months from now. And so I think your notes, Art, about cash, probably such an important reminder of why maybe it hasn't been as painful as it otherwise could have been.
Yeah, and my favorite question of the week was from a client who was asking about a boring conservative bond fund that I have them in. And so why, if we think stocks are going to do so well for the long haul, do we put anything in anything other than the stock market? And as you just suggested, if you're going to spend money, you don't want to have to worry about what's happening literally day to day in the stock market. And bonds are the same thing. I mean, you want to have a smooth ride in your bonds, but they will go up and down as interest rates go up and down. But I love the most boring of bond funds because I can count on them for distributing income on a regular basis and not going down too much if interest rates go higher, on the long end. So, build them and compartmentalize, have that safe money in cash so you can spend it.
And safer assets are offering a lot more competitive returns to stocks these days, where you can get a 5.5% return on a high-quality intermediate-term bond fund. Cash these days, returns are still somewhere between 3 and 4% on cash. So I'm content to allow cash to be a piece of client allocations, in part because safer assets really are offering a lot more compelling and competitive returns to stocks these days.
Yeah, it may sound boring, but I think in many ways, boring is sometimes the way to go. And I think to our earlier point, if you get paid to be boring, well, by all means, let's do that. Somebody that's not boring, our great colleague Joel Driesing.
What a segue.
I would be remiss if I didn't share how much Joel has been a big part of not just this show, but all of our lives here at Landis & Company for so many years. Joel, as of the end of day today, will be moving on to bigger and better, not leaving us necessarily, just finding new things to do in other places. And I can't, Joel, tell you enough how much we appreciate everything you have done for us. Your voice has been such an important part of who we are. And we only hope we can carry on the important things you've been able to share over the years.
Thanks. What do I say? Bob Landis brought me on here 16 and a half years ago and asked me to help coordinate communications. This is a firm that's always recognized that communications is an important aspect of a long-term relationship, and that's what this firm has been in the business of, is long-term relationships. So it's been great for me to work among you and to help coordinate all of the things that you do. I was a little less comfortable having my own voice in it. When Bob first asked me to be on the podcast, I was like, well, I don't really have anything intelligent to contribute here. And after a while, just sort of paying attention to especially the economic indicators and so on, and being on the show, I realized that intelligence doesn't really figure in so much.
I'm not sure how I feel about that.
Just kidding.
Yeah.
But, and just... I've learned so much by being here, if nothing else by osmosis. It's the things about what you all do. It's boring. This is boring work that you do. It's long-term relationships, and it's long-term work. It's people looking at their portfolios over a long term and not the day to day. I mean, a 15-year-old chicken isn't as interesting as a newborn puppy, but it's the long term that's important and that's boring. The other thing that was really impressed on me early is that what did Art say before? Get wealthier, for God's sake, which sounds like something you should put on a T-shirt. But that it's wealth that you help folks build and nurture for a reason, that it's not money just to have money, that you work with people to say, what do you want this money for? And let's figure out how you can afford that comfortably and enjoy what you've worked to save.
You know, and I want to say you've helped build me over all these years. I've had the pleasure of working with you for nearly 17 years. And Joel, I really appreciate the passion you have for like educating people and the passion you have for like your journalistic approach to all that you do. And efforts of full disclosure, in all of the articles that I've written over the years, Joel has helped me wordsmith every single one of them. So thank you for helping me form my own voice and my own message. I appreciate it.
You're welcome and thank you.
Yeah, likewise. I wrote a column for decades. Joel proofread bunches of those. And so he's helped me become a better writer, better communicator, and in the process a better advisor. So thank you again for all you've done for all of us.
Again, you all have that within you anyway, and you do that with your clients, and I'm glad to have been part of that and helping coordinate that.
Joel, I think you sometimes explained to me that you felt like an outsider in what we do in many ways, that your role often as a journalist meant you were reporting from the outside of things about what you saw happening. And in so many ways, I think you tried to come in with that perspective. You tried to be the kind of voice that was, well, here's what I see you all doing. But I have to be clear that I think from the very beginning, you were one of us. From the very beginning, you knew who we were and what we do. And you had some experience with Bob. You had some experience with some of us leading up to it. But I think maybe, unfortunately for the journalist in you, you're walking away as one of us and not as the outsider. So can't thank you enough for all you've done. We wish you nothing but the best on the way. We enjoy doing the program for you all. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.